Good day, fellow investors. I made this video on Apple, how my view the intrinsic value is 105 compared to the 200 stock price, and there was this great comment from Marianne. Guys, it seems like all the metrics do not matter anymore. This time it's different. Millennials invest into ETFs each month, everyone listens to old Bogle, so the market will keep growing no matter what. Every dip will be bought in hours, and she is absolutely correct. The S&P 500 is almost a 10x over the last 15 years, and the stock market seems to just be going up, and there is nothing we can do about it. So the key question here is, does it make sense at all to keep investing, keep value investing, or it is just better to go indexing, because until there is automatic indexing and buybacks, stocks will only go up. And let's go to the biggest owner out there, BlackRock, to just see what are the clear trends there. If you look at BlackRock's portfolio, 9 trillion, and most in wealth management and pension plans. So mostly automatic investments over time, and if they have, this is 6-7 trillion, likely another 200 million, 300 million coming in every year, perhaps even more. Compound that with the other two guys there, Vanguard, State Street, global pension funds, this and that, and then you have this. Record inflows for US ETFs this year, more than $1 trillion, and you can see here how inflows keep getting higher and higher. More inflows, more higher prices. Plus, on top of the inflows, we have the S&P 500 buybacks. So we are now around 200 something million per quarter, almost close to $1 trillion per year. Let's say that automatic investing and automatic buybacks by companies add approximately 2 trillion of new incoming flows into the stock market. 2 trillion of inflows. We discussed the inelastic market hypothesis 2 times over the last few years, because it says that $1 invested increases the market value by $5. This $5 is then also why stocks keep going up and will keep going up until there is automatic indexing and buybacks. So 100% here from Marianne, and great comment actually. And now, does it make sense to counter this? Can I do something? Stocks just keep going up, valuations are irrelevant, and does it make sense to go against the herd, or should we just play with the herd? Because since 2018, when Sven launched his research platform, okay, I made some mistakes, but I made 12% per year. The S&P 500 did a staggering 14% per year. So all my work has been, let's say, worthless, maybe not, but keep listening. So if this continues, then yes. But let's talk about what's going on here. With more money coming into the market, it is all about valuations expanding. So all those automatic investments don't care about price. The P ratio, 1980s begin, was around 8. Then it went around 15, 1990s, beginning 1990s, late 80s, 15. Then we had the dot-com bubble, but still, if we adjust also for the dot-com bubble and then for the global financial crisis, we were still at a P ratio of 15, and now the P ratio is 30. So you can see a clear expansion in valuation, almost a 4x expansion in valuation over the last 40 years, because interest rates went down, and then asset prices went up, more automatic investing, and then you say, that's why there is such an expansion in valuation. But this also means that people don't care about the price you are paying, and you can also see that with things like Bitcoin that just keep going up no matter what, and there is no difference here or here or here because it's just about the supply and demand. And here we come to something. The P ratio is 30 for the S&P 500, the P ratio is 10. If in 5-10 years the P ratio of the S&P 500 goes to 15, that's 50% down, and you can be lucky to get a positive return if that happens over the next 5-10 years. With my P ratio of 10 portfolio, I know I will make my 10% per year from just the business earnings. So that's the key difference, so I'll keep doing what I'm doing. Let's further discuss also the current situation. If we go to the great book Memoirs of Extraordinary Popular Delusions by Charles Mackay, written in 1841, here you have the summary. Prices go to absurd highs. Multitudes follow the crowds, abandoning reason for the safety of numbers. Greed blinds men. Tales of wealth and wonder. Tales of wealth and wonder. Men chase the promise of unknown. Men chase the promise of unknown. Fear, once unleashed, turns joy to despair and markets to ruin. You do not believe me? Masayoshi-san, look at his stock price. Look at this, 30,000, then it went to 1,000 and now slowly recovered to the current 10,000 yens. Remember, fear, once unleashed, turns joy to despair and markets to ruin. Men believe they command chance only to be humbled by fate. We don't know what will be the profits of this AI revolution. And we can see here technological improvements, 1920s, earnings going up, stocks following, great stories, everything great, only to be humbled by fate. Every mania ends in collapse as folly gives way to despair. Thanks, Charles Mackay. What could turn this ship is the key question. Well, interest rates. It is impossible to predict, so we can only focus on value investing. We have just received the 7-year asset class real return forecast from GMO, a little bit improved now with large US companies delivering negative returns, but US deep value delivering positive returns, depending on interest rates going forward. But then again, if I look at what they are doing, it's finance. Okay, Meta has likely been a buy as when we bought it 2 years ago. Oil, pharma, finance, oil, pharma, old tech, finance. So even if we go globally, healthcare, energy, basic materials, financial. So it is really going into sectors that I also believe have some risks, or I don't know much about financials and healthcare, so I know that energy and oil are pretty risky now, but even if we look at Europe, same story there. But if we go to Buffett, he did things differently. He just went to cash. 300 something billion of pure cash, sold his stocks, lowered his stock portfolio, and will likely do more. And that is because he is Buffett. GMO cannot sell because they have all this, I think there is 30 funds out there, so they need to collect those fees on every fund there. So they need to find something to be smarter. And yes, US deep value will likely do well, but maybe the S&P 500 will be minus 50 real terms. This will be minus 40. GMO will say, we'll beat the market, we have done it, and that's it. The key moral of the story, until this index fund mania, invest at whatever price continues, stocks will keep going up, but I'm not going to bet that this will go on forever. I'll keep doing my value investing. It works no matter what.